The simulation of Ariadne can be used in different types of businesses, actually in every business. We can group the businesses into three groups, roughly speaking. Banking, the core financial, it would include maybe asset management and stuff like that. Insurance, covering life, non-life, reinsurance, and then non-financial, anybody else who is not dealing with money purely, anybody who produces something outside the money space. These two are actually financial institutions, so exchanging cash flows for cash flows, and these are then the non-financials, exchanging cash flow for goods. But all have a financial side, even the non-financials. So you deal with your products, you sell it for money, basically. The way we deal with it and the way we can understand it is if I draw a balance sheet on this side and I draw a P&L statement on this side. So here we record value, and this is a photo actually. Here we record flows, mainly cash flows, but it's not just cash flows in here. And basically the change of the balance sheet is the P&L here. So we can say that if you are in the banking sector, our main focus is the balance sheet itself. Maybe let's do it like this. So almost everything which we do, we focus on the balance sheet, and we could say the P&L is a kind of appendix. Of course, that's a little bit roughly speaking, but the focus is here. And the P&L is just a consequence of my operations on the asset and the liability side. What do we mean by asset and liability in the banking sector? It's loans, it's deposits, etc. And of course, loans and deposits, they produce P&L, but that's like a side effect, so to speak. So for a bank, everything is if this is the total is 100%. Or we can do it like that, 100%. So say 90% or 80, I don't want to throw out the number. In a bank is the focus on the balance sheet. The P&L is more a consequence. There is also a P&L section in the bank where you produce via the P&L, which is other revenues, for example, revenues for wealth management. A pure non-financial, think about a chemical factory. They care about goods to start with. And they have production, they have salaries, they have machinery, all that. And all these salaries and pre-products, like what they have to put into the production, that is represented by actions on the P&L. For example, I pay a salary. That's recorded straight in the P&L. I buy salt, or I buy iron, and so on. That often is directly reflected in P&L. So for non-financial, the main focus is on the P&L. Maybe I have to turn it around here now. Maybe we have 100% here. So in a non-financial sector, most is profit and loss. And we can draw a line like this. The more somebody is on the non-financial side, the more important is the profit and loss sections. And for them, the balance sheet is like an appendix. Of course, they do have machinery, which appears on the balance sheet, and so on. Of course, they do have cash. They hope to have a lot of cash. But it's more like a little consequence of the entire thing. So the focus is on the P&L, and the balance sheet is an additional factor. In the banks, it's exactly opposite. The focus is on the balance sheet, and the P&L comes in. Insurances are in between. They are somewhere in between, so they have as well a lot of focus on the balance sheet, and they have a lot of focus on the P&L at the same time. So that's how we could express it. Now in Ariadne simulation software, that's also how it is done. If you look at the financial on the simulation of Ariadne, I put the wheel in the middle. This is the wheel which we see when we open the software. So here on this part, here we have the initial data. And here we have all the assumptions. And here we construct, we have the reports, roughly speaking. Okay, so and here within the assumptions, we have here what the risk factors do, what is the interest rates, FX commodities, etc. So this is what we call the MRSS, Market Risk Scenario Set. This is the counterparty scenario set, and this is the behavioral scenario set. So banks care much about these things. And then comes the future. This is the future part. The business, the dynamic, the specific dynamic. There's also some dynamic here. But here we have the OPSS and we have the MRSS here. The FSS. The FSS here. OPSS means Operational Strategy Set. That is much linked to the profit and loss. Not solely, but principally it has that view. The financial strategy set is very much linked to the balance sheet. So, if we now have a bank and we need to produce a future business, let's say like a budget, a planning here, the main part of the bank is the focus on FSS, where we define here the categories which we produce. For example, these are mortgages, these are maybe liquidity here, other loans, etc. And here are savings, deposits, etc. So basically what we do, we plan how much we produce of these assets here. We forecast the amount of assets and we make a forecast of the market risk scenarios, like how the interest rates will do and the FX rates. That forecast goes into this FSS module, where we give at each position the volume we produce, how much, what are the characteristics, and how is the pricing. That's basically what we do. And everything is produced here. Linked to these saving accounts, deposits, mortgages, and so on, is directly, actually in the background, profit and loss. It's a mirror here, where we then see how much income we make on the mortgages depending on the interest rates, how much expense we have on the savings depending on the interest rate, and for each of these positions we have a certain income or expense. We said we do little on that part of the P&L. This is the operational P&L. Maybe we should call it the operational. So that's the P&L which is not directly derived from the balance sheet. So here we have revenue. Here we have expense, and the remaining is then the profit. So here we define how much additional revenue besides the revenue which we get from the financial business. For example, it could be in a bank, it could be wealth management. That's a main driver, or some other service which comes beyond what we do on the contracts themselves. Or the expense, of course, this is all the salaries, the houses we need, electricity, etc. So all that is the expense, and hopefully the expense is less than the revenue. So the profit then goes into here. We have equity, and it will grow. Equity will then grow. This is retained earning, what we have here. But this part, although it's huge for normal people, it's a small part compared to what happens within the balance sheet. So the big cash flow happens here. These are very small cash flows relative to them. Of course, it's a lot of money than what people earn, etc. But the weight is here. So that's basically how a bank functions. Non-financial firms function exactly the opposite way. Basically, they think first about production, not about money. Let's take an oil producer. So an oil producer is drilling and to find oil. So there's a lot of investment to drill holes, and what they get is barrels of oil. Of course, they're selling these barrels of oil. So if you have the number of barrels of oil, plus then the price of oil in this market risk scenario set here, then of course the multiplication of it gives us then the income in dollars or whatever it is. So, but the main production is first oil. So they produce oil. So then they have a lot of salaries, equipment. They have maybe pump stations, whatever, which then produces expense. So it produces expenses here. And of course the equipment, that indirectly goes also to the balance sheet. So you have your investments, fixed assets. But you have a lot of expense here. Then of course from the sales of the oil you get revenues. And here, if you do not sell all the oil, you will have here like a kind of inventory. And then if you, for example, sell more oil than what you produced, then you will get here revenues here. So that's basically how you do it. So, but the whole thing is driven by what we call by the operational P&L, and this part is now here, what is mainly here defined in the operational strategy set. In here we define how much oil production we have, how much salaries, equipment, etc. And then we give, if that is basically, it looks like an Excel table. It's not Excel, but it looks like an Excel table. You have time here, time, and here you have the single items like salaries or oil production. So we take that as input, and then you will see on top here you have an instruction where you can say this line is, for example, an expense. That's all you have to tell. Once we give that instruction that it is an expense, we give you the exact account where the expense has to be registered, but the rest is taken care of. The money of then, if you have expense, so we know it's registered here, but then it goes to what we call the treasury, or that's where the money lies, where we have money, and it will take the money down from here and produce that expense here. That will happen automatically. But then if it's oil, for example, we can turn this, we say it's an inventory. plus some information, so we give some information in addition here, especially which P&L account and where the inventory is. We add this information. We only have to say this oil is an inventory. It will show up here in the balance sheet. It will show up here in the revenues here. And then it will produce inventory here, it will produce revenues, it will produce the right cash flows. In this case, because we just have drilled the oil, we have put it into the inventory, and we have recognized revenue, there's no cash flow. But when we then sell the oil here, then we will have a cash flow, but no P&L effect. All this financial knowledge is known by Ariadne. The only thing we have to define is where it happens and what happens. We have to give the instruction, it is inventory, and point to the specific accounts where it should show up. All the financial logic is then given. So which categories, which operational categories do exist which we need to turn operational information into financial operations? There are 7 known categories. It looks like it's a complete list. If somebody finds something else, please come to me. So far, nobody knows anything else. We have, on one hand, receivables and payables. That is the situation when I sell something, but I am not paid now, but will be paid later. That's a receivable. The opposite, if I buy something which I do not pay now but pay later. So the effect is, at the moment when I receive or pay, then it hits the P&L, but it does not bring cash. It will bring cash the moment when the receivable is payable, or is receivable, or this is payable, and at that time it will have no P&L effect. Costs, revenues, they have simple P&L effect, and they are just will be balanced in what we call the treasury. Means there is a collection of all the cash. It will go here, from where it can be invested wherever we want. Then we have the inventory. This is, we produce something like oil, but we do not sell it straight away. So it goes on inventory, so it has a P&L effect, but no cash effect. The cash effect will happen when we sell the inventory, but then no P&L effect at that time. We have investment. An investment is a certain payment at a certain point of time, and there is no direct revenue to an investment. Like, for example, if you invest in a dam for electricity production, you pay a lot for the construction of the dam. The revenue will not be directly from the dam, but from the electricity which you produce, and it will come back via the revenue stream from the P&L. So there is no direct link. So what happens to investment, it is written off. It wears off over time, so there is some empirical, we know from experience. For example, of course a dam will last long, but let's take a computer. We know we invest into a computer a certain time, and then we write it off. We can write it off linear, for example. We can write it off exponential, or there are certain schedules. So when we do an investment, so we would say, okay, invest here. That would then link directly to an account like a fixed asset. So that would link directly here. So it will, and here it will find a schedule, a write-off schedule. So it knows the point in time when the investment happened. That's part of the operational instruction. It will appear in the balance sheet, and it will be written off as time passes on, as per instructions which we have put here. Reserves is just a kind of opposite. So because here in the investment we have a cash flow here. This itself has no P&L effect, but then the writing off of the value goes then from here against an account here in the P&L here. The reserve is the opposite. So we have here in time, that's much used by insurances, for example. Assume we have insured against fire. Now we hear that a big fire has happened in an area where we have a lot of insurance. So the time we get to know that the fire happens, we have to put back a reserve. So this reserve itself is a pure P&L effect. It will be shown here as an expense here, but then as time passes, we know, for example, the payment happens here, so we would pay it here, or it could also be in steps, so something like that. So some payment here, some payment here. So these are expected cash flows. So we have the P&L effect here. Here we have only the payments, which are then again reflected in the treasury. So where all the money is collected, and from where we then invest into the specific case here. So these are the links between the operational side, the P&L side, and the balance sheet side here, seen from an operational or from a non-financial institution. Now finally, what is an insurance? I said an insurance is something between a bank and a non-financial. It has on the asset side where it invests into assets which are used to pay when the accident happens. There it's like a bank. On the liability side, it's more like a non-financial. So the liabilities are actually basically reserves put back for potential payments in the future. And when then the payments happen, then the reserves are released. And they function, as I said here, at the moment when you produce the reserve, it has a P&L effect, but in the moment when you pay, it has only a liquidity effect. Here, at that moment when you pay, treasury will go down here. Okay, so reserve is in between an insurance. For example, an interesting case yet, we have premiums paid but not yet consumed, not yet used, because we pay premium at the beginning of the year, but we pay for the entire year. So you have something like that. It's on the liability side. You get a cash flow. Let's say you get a cash flow as an insurance, but then you hit revenues over time. So here the revenue will be the income for the premier income. And this, by the way, is actually a negative investment. That's how we model it. So we have an investment on the liability side, which means somebody else invests in us. So all our customers, by paying at the beginning of the year, basically they invest in us. And then we write it off over time, so it produces revenue here. And against this, of course, we will then have the accidents, where we have the reserves, which then eat up those revenues. But we see that the cash flows here come early, here they come late. In the meantime, of course, the cash will be in the treasury, where it can be invested, where it will then produce the specific income, which depends, of course, then on market conditions, where the MRSS again kicks in. Here this part, which then produce additional income, which then can not only be used to pay back for the accidents, but to pay for salaries in the insurance or for profit here. Okay, so that is the relationship between how banking functions in Ariadne, non-financials and insurances.